again, it's Steve from Clearly Training, and you're watching our Finance for Non-Finance People series. And this is number 4 in the series out of 6. And this one is about the profit and loss account, or as it's also known, the income statement. And remember, we've looked at this before. We looked at it in video number 1. We also looked at it in video number 2 on the accruals principle, and we're looking at again today in number 4. Remember, the profit and loss account, or P&L as it's also known, has got lots and lots of different names. When it's used internally, it's sometimes referred to as the management accounts. Some organizations call it the budget report. Its official legal name is the income statement, as well as the profit and loss account. It's got lots of different names, but after today, you'll always recognize it because the structure of the profit and loss account, or P&L, is always the same. And that's what we're going to be focusing on today, is the structure of the profit and loss account. So let's have a look and see how that structure works, what actually goes into a profit and loss account. And I've used abbreviations at the top of this slide here. I've said P&L stroke IS for income statement. These are the things it shows. Okay, so first thing is it shows sales. Sales, another one that's got lots of names. It's also known as revenue. Revenue is probably the most common word I see used in legal documents, in legal profit and loss accounts, revenue. But turnover is another common one, perhaps a little bit more old-fashioned. You could even just have the word sales, or some people might use income, or if you're like a legal business or an accounting business, you might show fees as the word. But you can use whatever word you want. It's the one that starts the P&L always, though. The income of the business is always there at the top. Then below that, we have the costs of sales, or as they're also known, the direct costs. And these are the costs that are there which have produced the income. They've directly produced the income. I think I gave you the example earlier on in the series of, let's say you had a very simple business and you were selling apples and you decided to use a market stall to sell those apples on. So the direct costs, or cost of sales, are the costs of the apples themselves that you're going to sell. And then once you've paid for those apples, of course, you've got to pay for your market stall. Now, the costs of owning and running the market stall and the costs of transporting the apples to the market stall, they're not necessarily direct costs. We'd normally call those indirect costs or overheads. So we've got direct costs, the cost of the apples in my example, and then we've also got the costs incurred to support the sale of those apples, and that would be things like renting the market stall, the fuel for the van to transport the goods to the marketplace, the depreciation of the van if you owned it and it was one of your fixed assets, just to link back to video number 3 on the balance sheet. All of those costs would be overhead costs. So that's the second category of costs in there. And then we'd also have, of course, always depreciation. I've just mentioned it in terms of the van. Now, that was an example of depreciation of an item which was part of the overhead costs, but you can also have depreciation which goes in the direct costs category as well. So for example, if you were running a factory and you were manufacturing goods, then the cost of the machinery would be a direct cost. And so the depreciation of the machinery, any repairs to the machinery, those costs would go into direct costs as well. Whereas in that factory, the costs of the administration offices, so perhaps they might be using computers in there, tables and chairs, desks in the offices, those depreciation costs would go as part of the overhead costs. So depreciation could go either as an overhead cost or as a direct cost. It depends what the fixed asset does that you're depreciating. Okay, so depreciation is included in one of those categories. Okay, I'm going to be talking more about that later and be showing you something interesting with depreciation as well later on. Don't forget, there's also interest and tax that gets deducted in a legal profit and loss account. You see the interest that you're paying on loans, and you see any tax that you're paying deducted in the profit and loss account as well. Okay, now I've got a sort of an overview chart of what a P&L typically looks like. So as I've just said, this is just a repeat really of what's on the last slide, but it's a bit more visual. So you've got the revenue at the top, then you've got the direct costs, or as they're also known, cost of sales. You can use either of those phrases. And remember, as we said before, you get depreciation in the direct costs if you're using a fixed asset to create those direct costs of sales. Then what we do, and we've seen this before as well in video number 2. Then what we do is a little subtotal. So we take the sales turnover less the direct costs or cost of sales, and we do a little subtotal, and it's called the gross profit. And the gross profit is the profit before you deduct your overheads. Gross, remember, means big in German, and it's the big profit. It's the big profit before we're deducting those overheads off. We really have to, as a business, be able to make a gross profit in the short term if our business is ever going to be successful in the long term. We need to be selling things for more than it effectively costs us to make or buy them. Yeah. And then we've got overhead costs to take off as well. Okay. And, those overhead costs will also include depreciation, as we said. The depreciation of the fixed assets that are part of those support costs, that needs to go in that overhead cost category as well. And what we then do is we then deduct the overheads from the gross profit, and we get what we call our operating profit. Now, by the way, and we'll come back to this later, operating profit also has a more modern name. It's sometimes known as the earnings before interest and tax. So it's the earnings of the shareholders before deducting the interest and tax off it. And that's often abbreviated to EBIT, earnings before interest and tax. EBIT, E-B-I-T. You might see that acronym sometimes. Okay, then we will deduct off interest and tax. We normally do this in 2 separate stages, but I just lumped them together there. So we deduct the interest and tax, and then we get the net profit. Now, the net profit can also be known as earnings, and that's why the operating profit is the earnings before deducting interest and tax, and then we have the earnings or net profit themselves. And what do you do with the earnings, or net profit? Well, you either pay them out to your owners. Now, if it's a limited company, the payment to the owners is known as a dividend, or you can keep those earnings, that net profit, within the business. You can retain the profits. And you might want to do that if you want the business to grow and expand. And the owners of the business will often be very happy for you to do that, because they know if you keep the money in the business, then it will help the business grow. And often businesses will pay some money out to the owners, to the shareholders as dividends, and they'll keep some within the business. And those ratios of how much they keep and pay out will depend on what they want to do, what the future expectations are for the business, and how happy they want to keep the shareholders, of course, as well. So that's a good overview structure of what the profit and loss account looks like. And every profit and loss account will have that same structure. Now, sometimes if you're dealing with profit and loss accounts at work, you might only see a portion of that profit and loss account. So if you're working in a department that is a department that has its own sales, it might be a section of the business, a business unit, a complete business unit with its own sales and costs. Often you'll get sets of internal profit and loss accounts that look very similar to that, but you won't see interest and tax deducted. In other words, you'll only go down to the operating profit or EBIT line, because as internal managers within a business, you don't need to be concerned with interest, because interest is all to do with how the business is financed, and that's a decision that the higher level of management will make. The directors will make those decisions, and you won't want to be concerned with tax, because that's a very specialist area. And at the end of the day, if you're paying tax, that's a good thing. It means you're making profit. So as managers of the business, you don't usually see the interest and tax shown in the profit and loss accounts you get presented with. Okay, so that's the basic structure of a profit and loss account. Let's move on and look at some profit and loss terminology. Hopefully I've covered most of this already, but it's good to repeat, remember, because accounting is a language, and languages need repeating and reinforcing. So let's have a look at some terminology. First of all, gross profit. Yeah, we've seen the gross profit. What is it? Just have a little think before I flick it up. Can you remember? The gross profit is the revenue less the direct costs, or as they're also known, the cost of sales. The next one we have is operating profit. Remember, operating profit has got another name, earnings before interest and tax, or EBIT. There's that little abbreviation you can see there. What's the operating profit? See if you can remember, and I'm going to flick it up now. The operating profit is the gross profit less the overheads. So the gross profit, deduct the overheads from that. Then we've got the operating profit, or as it's also known, the EBIT. Next, we've got the net profit. Do you remember how you get to the net profit? Have a think. The net profit is the operating profit less the interest, and then less the tax. Net profit, remember, is also known as earnings, and that's the last bit of terminology up there. Earnings is the same as net profit. It's the figure at the bottom of the profit and loss account, which you can use either to pay your owners, and if the owners are shareholders, we call that payment a dividend, or you can retain within your business to help the business grow. So the earnings of the business are the bit at the bottom, the net profit. The earnings are the earnings of the owners, of the shareholders of the business. Okay, there's a legal profit and loss account. That's how the legal profit and loss account is laid out. When I say the legal profit and loss account, I mean, for example, if you're a limited company, the profit and loss account that you present to Companies House that you have to file legally every year will look something like the one I've presented up there. It will have everything in it: sales, less the cost of sales, giving you the gross profit. Then the overheads. Now I've split the overheads up into the different categories of overhead that you might see there. So there's a little bit more detail than you'd normally see, but I've indented that to the left just so you can see how it's broken down. So you've then got the overheads, and you've then got the operating profit, or EBIT as it's known. And then you've got the interest deducted in a separate line, and then the tax, and then the net profit, or this could also be called profit after tax, actually, or it could be called earnings. And those earnings will then be paid out either as a dividend or they'll be retained within the business. So that is what a full profit and loss account that the business would show to its shareholders would look like. And as I said, internally, if you see profit and loss accounts, they won't necessarily have all of that detail. In fact, it would be very unusual if you ever saw interest and tax deducted in an internal profit and loss account that was presented to the managers, because the managers aren't able to control those figures. As a general rule, if you do receive a profit and loss account as a manager within a business, the profit and loss account, or the portion of it that you see, will be the bits that you are able to control. That's a general rule of thumb. So that's something you might like to pick up later on in our series on management accounts. We'll be dealing with that in a little bit more detail, but that's for later. Okay, so that's what a profit and loss account looks like. Let's have a look at a couple of questions here. So the first one is, what does the term gross profit mean? Have a look at those. Maybe want to pause me. I'm going to give you the answer in a second. Here we go. Answer number 2, it's the revenue minus the direct costs. That's what the gross profit is. Question number 2, which of the following is not an overhead? So it is not an overhead. It means it's a direct cost, part of the cost of sales figure. The answer again is number 2. The wages of the production line workers are direct costs. The other things, the accountant's salary, the office electricity costs, the rent on the office premises, they are all overheads in nature. They're all support costs. The direct cost in there is number 2. So that's the right answer, because that's the one that's not an overhead. There you go. A couple of questions to test you. If you didn't get those, go back and have a look at the video again. Make sure you've got that knowledge before you have a look at the questions again, and then finish with this video and move on to number 5, the penultimate one in the series. I'm Steve from Clearly Training. Thanks for listening, and see you in the next one. Bye.